Alright guys, targeting 20 pips per day. I think if there was one thing that gets new traders in Forex more excited than anything is the notion of targeting or profiting 20 pips per day, because you've probably done this yourself. You sit down with a piece of paper and a calculator and say, okay, now if I start with X amount of money and I make 20 pips every single day and I risk, and I earn a consistent 20 pips every single day, I'll be able to quit my job in a year. Well, look, I'm going to tell you right now before we go any further, I'm not going to tell you that you're going to make 20 pips every single day. All right? It's not imperative that you do make 20 pips every single day. But if you are a scalper and you're comfortable with that type of trading, I think this concept is going to lend well to that. It'll also answer the problem that you're going to encounter of being wrong in your trading. You have to have a way of overcoming or offsetting the absolute eventuality that you're going to be wrong. And I think you're going to find that this method is advantageous to you as a new trader if you have scalping in mind. It'll obviously show you how to scalp, but it'll also allow you to have a built-in process of mitigating losses, and it'll also have a developmental approach to higher time frame trading, like short-term trading and swing trading. Even though you may not be comfortable doing that now, it will develop your ability to do that type of trading. And it's understandable if you're uncomfortable with that style of trading now. You want to be in and out real quick because that's what you think is safer. But I respectfully submit that the only way you make real money in trading, whether it be Forex or any other market, is you want to be holding for larger moves. And if you're only going to be taking 20 pips and getting out, you're never going to see the extrapolated appreciation in your equity that really should be the focus point for you as a trader. So let's get this thing moving, and we'll develop our understanding on how we can profitably and consistently trade by scalping. Alright, keys to profitable scalps. Now, what does it require to scalp the Forex consistently and profitably? First and foremost, you want to have an understanding of price action theory. That means there's specific times of the day when the market will trade with a particular volatility, and that is learned by markets opening and closings. Certain days of the week are more favorable. All those components are covered in other videos and modules. And I would like to suggest now, if this is the first video you've ever seen by me, I have a complete work on the Forex and my approach to trading it at babypips.com. If you go to their forums section, underneath the section called Newbie Island, I've hosted a thread there by the name of what every new and or aspiring Forex trader still wants to know. It's grown quite popular with new traders, and we have a really good community of folks there that would be more than willing to give you a hand and answer a lot of your questions that may arise with this module if this is the first one you've seen. And obviously, if you've already been following me for a number of years, you can just refer to the Power 3, the swing trading and short-term trading modules, and the Judas modules, and they will all complement this scalping presentation. And also you'll learn all of the price action theory concepts that I employ in my trading. So it's very important you understand that. You also have to have a firm grasp of key support and resistance levels, and they're determined by the higher time frames: monthly, weekly, daily, 4-hour, nothing lower than a 1-hour. But if you stick to the daily and weekly and 4-hour, I think you'll find that those levels are very key by nature. You want to be trading higher time frame bias. That means whatever the higher time frames, weekly, daily, 4-hour, whatever those directional biases are, higher or lower, if you trade in those directions, I think you'll find that trading, whether it be scalping or short term, is much easier and very quick to cover the dealing spread and be on the profitable side of the trade by focusing on the higher time frames. To be a profitable and consistent scalper, you will have to identify predetermined profit objectives, and you need to be taking profits routinely, and you need to do it often, because we are not perfect traders. We will often find ourselves on losing trades, but that's not a problem. The problem is if you continuously risk too much and you don't take profits when it's there for you to take, that's a problem. So you need to be developing the mindset of taking profits at predetermined levels, and you need to do it routinely, and you need to do it often. Trade one or two pairs at max. Okay, if you're scalping, you only need one or two pairs to be doing that. Okay, so get cozy with one or two. Understand its characteristics. I favor, obviously, if you've been following me any length of time, I favor the cable and fiber, which is the British Pound USD pair and the Euro USD pair. So I can make all the money I'll ever need or want with one or two of those pairs, and because of my analysis concepts like the SMT and smart money applications, I use both those pairs to complement the other. So it's advantageous for you just to focus on one or two. Don't be lulled into thinking I have to be following 20 different pairs. Unless you're a trend trader and you're looking for strong trending markets and then narrowing down to those stronger markets, that to me is the only benefit of following so many pairs. All right, the basic scalping method for buying. Okay, we have here the vertical line delineating midnight my time, which would be equivalent to 5 a.m. GMT. Okay, and it's going to be with the understanding that you understand the London Open setup, how the high or low forms in the first 4 hours of trading. If you have not yet looked at the London Open video, I would suggest you do that. This would make much more sense to you. Okay, but here we have a setup where we have a key support level noted here. And this is going to be a higher time frame. This could be a daily high or low. This could be a significant weekly low or high. But we're just going to note it as a potential support level. And we're going to be waiting for the Judas for this particular day to unfold and break down out of the Asian range. Okay, and price may drop down out of the Asian range, retest it as resistance, but ultimately move down, approaching that key support level. And here is where we, as professional traders, anticipate. We do not react. We wait for price to slam down into that key support level. Now there's two ways you can approach that. You can trade it on the pure notion that that is a support level and there should be a bounce, and when your candles are bold-faced bearish, you trade right into that and buy it right there. Okay, this could be a turtle soup buy, in other words, a low penetrating a previous low that's not being noted here, but we're just going to focus on the pure support play and wait for the optimal trade entry, and that would unfold with a price bounce away from that support level and then a small retracement. That would be your optimal trade entry here. Now, buying this, okay, you need to go into every scalp with at least a larger term price move than 20 pips, okay, because this will develop your mental psyche for profitable trading, and you'll develop a professional perspective on the markets, and you won't be so worried about these small little gyrations that 20 pips are. That's what they are. They're such a small little minor move. But as a scalper, you want to be focusing on that first 20 or 30 pips, okay, off that key support level. Now, the way you're going to scalp is you're going to enter on double tap. Okay, double tap is a entry technique that I use where I'll take the position that I'm going to be taking on any particular trade and I divide it in half. Now, you can trade this several different ways. You can have two orders entered at the support level here to be buying, and let's assume for a moment that you're trading two mini contracts. One mini, okay, you set an order to buy it on a limit or on a stop or whatever, however you're going to trade it, but you'll be buying basically with the premise in mind that that's a support level and you're looking for a bounce there. You enter two orders, one to get in and then exit at 20 to 30 pips. The second is entry at the same price level as the first order, but it has an open-ended exit point. Okay, both entries on the entry will have the same protective stop of 20 pips. All right, so you're going to be risking 20 pips. Now, if you're risking a maximum of 2%, this is what I advocate here also, please do not risk more than 2% on any one of your trades. You're going to be looking to take 50% of the position, the total position, off at 20 to 30 pips. Now, if you're new, take 20 pips and be done. Don't reach for 30, but take 20, okay, and you'll get a 1% gain. If it's profitable, that's your scalp, okay? The remaining portion of the trade, you're going to allow that secondary portion of the trade to pan out and trade up into the fulfillment of the daily range. Okay, and look for the video module Power 3 for more information on that. But that second portion here, okay, that's what you're going to be riding out, okay, for the daily range. And you're going to look for time of day objectives, that being the New York Open. You want to look for confirmation it's going to continue trading into the 1500 GMT or London close time frame. And if you're really gung-ho, hold for 1800 and maybe into the next day. But that second portion of the trade, that's where you're going to make a huge amount of equity increase. The first portion, where you get out at 20, 30 pips, that satisfies the inherent nature in all of us as humans. Number one, that we got to be right. Okay, so you'll be able to take money out of the market. You'll feel good that you were right. You took profit, and now the remaining portion that's in the market after you take that first profit, the second portion has a protective stop at break even. Okay, you do not want to trail your stop into the daily range, because price can trade back down, take out your stop, and then it still unfold and make the daily range high, and you don't want to be tripped out early. So don't be so eager to trail your stop tight. You're going to allow the price movement to fulfill the daily range. You've already profited on the day. You can't lose. You've already made 1%. And if you could do this a couple times a week, 10 to 12% return a month is absolutely doable. If your approach to doing this is routine and you're not risking a whole lot of money. But the key here is what I want you to notice in that first portion, you're taking 20, maybe as much as 30 pips out of the market. If you're risking 1%, you stand to make 1 to 1.5% on your first profit, and then you go to break even. You can't lose money. But look what happens in the second portion. If the daily range, average daily range, is approximately 100 pips, and you're buying near or at the very low of the day, and that's what this concept highlights, you're risking 20 to hopefully make as much as 80 to 100 pips. So your reward to risk is as high as 5, anywhere between 4 and 5 to 1. Now, if you do this type of trading, over time, you're going to have losses. But look what happens on that second portion. That second portion can more than offset a whole week's worth of losing trades. So if you had 3 or 4 setups throughout the week and you lost on all of them, all you need is one of these and you'll erase all of that and still have a profit. Okay, so that's what I want you to understand. When you go back to the thread on baby pips, go to the risk management module, you'll see how by targeting trades with 3 to 1 or greater, that's how you let your profits run. That's how you mitigate the average cost of doing business by taking controlled risk in the market and then absorbing that loss. You have to look at that as a cost of doing business. And if you owned a grocery store, grocery stores don't sell everything that's on their shelves. Okay, car lots don't sell every single car they have in their inventory. Okay, so you have to assume realistically that you're going to absorb a loss. But by trading like this, number one, it's going to teach you how to hold for higher term profit objectives, to learn to develop into a short term or a swing trader. You're going to be comfortable because you're going to take the risk out of the trade very quickly. You're going to take profit. You're going to be sitting on profit. So even if you only make 1% and the second portion comes down and takes you out of break even, you still made 1%. And if that's all your trades ever pan out for the entire week, a couple different times, you still fare out well. Okay, so it answers all of the major barriers to new traders, and it gives you a complete trading system, quote unquote, okay, an approach to trading the markets. And it is absolutely how I do my trading, and all of my trades are entered. If I'm going to be scalping, I still trade it with a swing trader or short-term trader's mindset, and I allow a certain portion of the market to pay me. I take first profit, go to break even, and I do not trail that stop loss up tight unless I'm against the higher time frame bias, and that's the only caveat I'll introduce here. Obviously, the reverse can be said for the sells. Okay, we would identify a key resistance level. we would anticipate you to swing higher, trading up into a key resistance level. Optimal trade entry forms, you get short. You're going to risk 20 pips. Okay, time of day obviously would be London Open, and this would be hopefully the high of the day forming. You could be seeing SMT divergence here to confirm the high is also posted for the day. Price, when it breaks down, you want to be taking your first profit at 20 pips. And again, much like the buy, we're going to be entering on double tap. Your total risk trade is 2%. Now, obviously, if you want to be comfortable with risk, you can be risking a total of 1% and splitting your positions in half, risking 1/2 of 1% of your equity. Okay, and then letting the second half of the position remain on the the other half of 1%. But you're going to take half of the total position that you assume at the short off at 20 or 30 pips, banking 1% gain, or if you're going to hold for 30 pips, which I'm not advocating if you're new, take 20 and be happy with that. Move your stop to break even on the second portion of the trade, but the first portion, or 50% of the total short position, you're going to bank at 20 pips. Okay, and then you'll realize a gain of 1%. You cannot lose on the rest of the day, and you let that second portion run for the remainder of the day, hopefully fulfilling the daily range. Now that second portion, or 50% of the remaining position that you shorted at, you're going to hold for that daily range. That is going to be monitored, okay, throughout the day, and you're going to look for time of day objectives, that being the New York Open. You want to look for confirmation, and again, look at the New York Open module on the Baby Pips thread, or look at it on YouTube, and you'll find how I look at the New York Open as a potential trading opportunity. But you want to be looking for a confirmation that you're going to still see weaker prices going into London close, if not into 1800 GMT. But the times of the day would be New York Open, approximately 7 a.m. My time, or 12 GMT, and then 1500 GMT, which is London close, around 10 o'clock in the morning my time. In that 10 to 11 o'clock hour local New York time, that's typically when you'll start seeing profit taking, or the low would form on a down day, and then it'll consolidate going into the close. Or if you're really gung-ho, hold to 1800, no later than 1800 GMT. And if you're on a higher time frame swing, and if you use this to get in sync, you could also just hold on to the next day. But you have to be willing to absorb some retracement. But again, we're just covering the salient points for scalping. Just for the same day, exit at no later than 1800 GMT, but target about the 1500 GMT time frame. Keeping the stop outside of the daily range. You've already profited on the day, you banked 1%. Do not be so eager to trail the stop so tight unless you're trading against the higher time frame bias. And that's the only caveat I'll enter here, because if you're selling short and the overall higher time frame bias is up, that's the only point that I would start tailing the stop loss. And I would only start trailing it when we approach that 1500 GMT time. And this is the same if you were using the buy example we just covered. If we're going long, scalping in a higher time frame sell program, in other words, it's overall bearish long term, and you've scalped against the higher time frame, then obviously going into the 1500 GMT time on that long that we just covered, I would tighten the stop up as we approach that 1500 GMT time, not willing to give up any of the profits. But when we're in sync with the higher time frame, as I am really advocating here, don't be in such a rush to trail the stop loss so tight. Just let it do its thing and trade into that 1500 GMT time, and then obviously you can look for the stop to start tightening up. All right, where's the easy money? Are you a good swimmer? Ever try to swim against the current? It is difficult, and you cover very little ground with maximum effort. However, if you trade in sync with the swing or short-term flows, and scalping can be easy. When you're looking to scalp the Forex or any asset class, be it stocks, futures, or bonds, it is far greater odds of success when you trade with the tide. Trying to buy even when scalping, when the market is poised to trade lower, stakes the probabilities against you. Conversely, with shorting in bullish environments. So really the highest probability trading, even when you're looking to scalp, if you're looking to go short, the higher time frame should be overall bearish anyway. If you're looking to go long, the higher time frame should be bullish. It's really that simple. But if you wait for those environments to get in sync and you trade with that environment and that perspective in mind, you'll find that your trading can be absolutely rewarding, very, very low risk, and you'll find that the dealing spreads are covered quicker, and you'll be much more profitable and consistent overall. And here's the main salient point: you won't feel such an emotional tug. You'll have a comfort knowing that you're trading with the higher time frame premise in mind, and you won't feel so anxious as the trades unfold. I've said this so many other times in other videos, but it doesn't take much to build it up, guys. If you're not comfortable swing trading or short-term trading, there's nothing wrong with that. It just means your personality is not best suited for that type of trading. However, if you are comfortable with very short-term trading, or scalping as I refer to it, 20 pips can still build incredible wealth over time. Imagine making 2 or 3 profitable scalps that net your account 40 to 60 pips for the entire week. This can more than double your equity annually, and you wouldn't spend much time at all in the marketplace. Now imagine what the other portion of your trades left to run for the daily range would do for your bottom line in addition. Think about that. If the average daily range is approximately 100 pips and you're risking a total of 20 pips for the day on that trade, you're taking first profit off at 20, that second portion can stand to profit as much as 80 to 100 pips. That can offset so many losing trades initially. So having that mindset, you can see that having even a small account, if trading this way, you can rapidly build your equity up, okay? And then that's what you want to be focusing on. Don't be so fixated on having to make huge amounts of profits, huge amounts of pips all the time, okay? Go into these trades, even though they're scalps, with the higher time frame premise in mind, with a swing trader or short-term trader's perspective, holding for the daily range, taking first profit. You'll find that it's absolutely doable, and I believe you can do it.